Over the past month, we've seen more support for the theme of as good as it gets. Data releases a bit softer, and we've seen slippage in the economic surprise index. Same thing, we're looking at US profits. They're under pressure as we hit a mature stage in the economic cycle. Labour markets are tightening. That's leading to higher wages and also poor productivity growth. So costs are going up. Firms then can raise prices. In that case, we see inflation and we have to worry about the Fed response, or we can see profit margins go down. In some ways, that's already started. Listed firms should do a bit better, but obviously it's going to be an area of concern. There's been lots of political noise lately, but despite that, we think the Fed will keep on raising interest rates. Financial conditions have actually loosened over the past 6 months, even though we've had 2 rate hikes. That's partly because of the weaker dollar and partly because of tighter spreads. But that just means the Fed's going to have to try harder if it wants to slow down the economy. Even so, fiscal policy, monetary policy, they're both a long way away from levels where we'd need to worry about recession risk. So certainly we worry about a protectionist shock, but overall policy settings are still quite supportive. So overall, we've not got any great worries about the growth outlook, but it does seem as if things are as good as it gets.
May was a relatively uneventful one in global markets, with equities still very much trapped in a range-bound pattern. And this despite solid earnings, a good earnings reporting season for the first quarter of the year. Almost all global equity markets from the US and elsewhere had earnings in line with market expectations or better. This was enough to sustain market levels, but did not quite ignite a rally of any major significance. It can be noted, though, that Europe was one of the stronger performers through the month, as some of the political issues, some of the political headwinds receded, and economic performance generally across the region stayed very well on track and looks to do so for the rest of the year. Looking forward, we remain cautious. We prefer not to add additional weight, certainly not to the equity allocations we currently have, especially having upped Europe to neutral last month. The overall risk stance thus remains somewhat on the defensive side, but with enough sector exposure to have a reasonable chance, a reasonable amount of upside to market moves. However, in line with our effort to keep looking for value in sectors that have lagged, we have downgraded global industrials, but we upgrade energy after the energy sector put in a spell of underperformance, despite the fact that the oil price had a stable performance. Our outlook for oil is for further range-bound trading, making it quite possible then that the energy sector will make up the shortfall in performance that it has suffered over the last few quarters. Fixed income markets, and especially credit, also had a quiet one in May in terms of overall price performance, but from the point of view of new issuance, new records continue to be set. Investors have been putting money to work in this sector all year and are very comfortable to allocate large amounts to high yield as well as into emerging market bonds. We maintain a positive stance to both of these sectors. For the immediate short term, the picture on the global political front, geopolitics, seems to have calmed down with elections out of the way and with market levels of volatility has receded in accordance. It has been a recurring theme of us to point out that there may be opportunities for the savvy investor to gain protective exposure using low volatility. We reiterate this theme again in this month, and we plan to follow up with implementable trade ideas to use this theme.